And then the next paper is Risk Management for Hedge Funds, Introduction and Overview. We're asked to compare and contrast investment perspectives between institutional investors and hedge fund managers. So just in that contrast, the author suggests that hedge fund managers is the best judge of the appropriate risk-reward trade-off and should be given broad discretion. Trading strategies are highly proprietary and should be and understandably will be jealously guarded. Return is often the ultimate objective, maybe the only objective, and risk management traditionally was not central to the success of the hedge fund. Now this reading's not exactly recent, so we could probably say that there's been more of a risk management mindset in the hedge fund industry subsequent. Regulatory constraints and compliance issues are generally a drag on performance, and there's little intellectual property involved in the fund. The general partner is the fund. And then in contrast to the hedge fund manager, the institutional investor, who is the fiduciary, as the fiduciary, institutions need to understand the investment process before committing to it, must fully understand the risk exposures of each manager. Performance in this case is not measured solely by return, so notice the contrast. The hedge fund manager is focused on maybe exclusively return. The institutional investor has a broader set of concerns than just return. And then risk management and risk transparency is essential to the institutional investor, and they tend to operate in highly regulated environments. And then the intellectual capital should be by definition more institutionalized for the institutional investor. The authors assert that proper risk management can itself be a source of alpha for the hedge fund. And the example here is just a fund that has an expected return of 10% and a sigma standard deviation of 75%. So that if the risk manager can simply just truncate that distribution on the downside, that automatically adds value. And the limitations of value at risk. So thematic aim that we've seen in the FRM. 1, VAR cannot capture the heterogeneous spectrum of risks among various hedge funds. 2, VAR is a purely statistical measure of risk with little or no economic structure underlying its computation. 3, VAR is notoriously difficult to estimate. Tail events happen rarely. And 4, VAR is an unconditional measure of risk. Calculations are almost always based on the unconditional distribution of profit of a portfolio's profit and loss. And then survivorship bias. So this is thematic with hedge funds, right? They're very closely associated with this idea that survivorship bias creates a difficulty in analyzing the performance of a hedge fund strategy. Survivorship bias implies a distorted sample, which is to say the exclusion of the zeros. Few hedge fund databases maintain histories of funds that have shut down, partly for legal reasons in some cases. And most studies have shown the impact of survivorship bias can be substantial. So I've seen numbers like the survivorship bias overestimates the returns of. I've seen from 1 to 4% based on the studies that I've seen. Dynamic investment strategies imply dynamic risk exposures. And while modern financial economics has much to say about the risk of static investments, there is currently no single measure of the risk of a dynamic investment strategy. Phase locking phenomenon. These are situations in which otherwise uncorrelated actions suddenly become synchronized. For example, in the summer of 1998, default in Russian government debt triggered a global flight to quality that changed many of the correlations overnight from 0 to 1. You may recall that's one of the that was the exacerbating event in the long-term capital management case study. According to the authors, the most reliable way to capture phase locking phenomenon is to explicitly model it. For example, let there be a phase locking component or term in the linear combination expression that's a toggle on or off for phase locking. And how can autocorrelation returns be used as a measure of liquidity for the asset? So notice this aim is exactly the same idea really as what we saw in the previous paper, same author, Andrew Lo. Again, autocorrelation return as a proxy for relative liquidity. 1. Market efficiency. The degree of serial correlation in an asset's returns can be viewed as a proxy for the magnitude of the frictions, and illiquidity is one of the most common forms of friction. Put another way, we saw this before, a strongly efficient market should reveal no serial or autocorrelation. But there's a second motive at play here. Managers may have an incentive to smooth their returns. And in the case of illiquid securities, hedge fund manager may be able to exert some discretion in marking the portfolio's values at the end of each month to arrive at their net asset value.